Okay, here we are at 11:10. So welcome everybody to this week's session of the CEDAR seminar. Happy to see many of you online and also you here in person, which is really great. Tonight, this afternoon or tonight, if you happen to be in London, we'll be featuring a presentation, a causal approach to test empirical capital structure regularities. So I noticed this paper in a journal of finance and data science at the end of last year, and I was very excited about it for 2 years. First of all, because it's about causal inference, which, if you know me, is one of my hobbies ever since I encountered Udaya Pearl's book, which came out in 2018. It's very kind of wonderful kind of statistics. If you haven't tried Pearl's book, I recommend it. To give context on how we can learn, despite what they told us in Statistics 101, that you cannot conclude causation from data. Well, some people think sometimes you can. So it's a great subject. So I love the title. And then when I looked down to the two authors, I saw one name I didn't know, Cenci, who is in Imperial College, and great to get to know you, Simone. Thank you for joining us today. It's Stephen Kielhofer, who I've known for decades, who is one of the leading lights in finance in a way that brings together really insightful research and business acumen. I won't begin to touch on Stephen's resume, except if there's a company which goes by a sort of a mysterious acronym, KMV, which is not only prototyped ideas in theory, but also in practice and how the two connect. And in KMV, if you haven't seen it, please do look it up. The K is Kielhofer. So there you go, Stephen, over to you, and to you, Simone.
Okay, so I'm going to give a bit of a preamble here and then come back for a bit of discussion in the middle of the paper. Simone is going to make most of this presentation here, I think. This paper was really motivated by his interests in this causal approach, and but what I wanted to do is, as part of the preamble here, is just talk a bit. Oops, my slides aren't advanced right now. So
press one.
okay. Okay. Yeah. Okay. So I want to give just a bit of a preamble here on kind of what we're up to, because this is kind of a funny paper in a way. So there's a huge literature out there on capital structure. To summarize it, you need to about write a book. And you can sort of roughly put the approaches into a few categories. Is that good? Okay. The first of those are, but basically go under the moniker of static trade-off theories. And they were really motivated by the capital structure relevance theorem of Modigliani and Miller, which basically said under these sort of ideal conditions, capital structure didn't matter. And and since everyone thought capital structure does actually matter, they said, okay, there must be some violation of these ideal conditions. And those ideal conditions included no taxes and no costs of bankruptcy. So the idea of Modigliani and Miller was, bankruptcy was kind of a non-event. If a firm was unable to pay its debt, then you basically just gave the keys over to the debt holders, and everything it was just a transfer and shipped it over. And so static trade-off theory started out from just a very simple idea of saying, okay, there's some advantage of using debt, and that is debt tax shields, and there's and if that was all there was, then everyone would be 100% leveraged or close to it. So there must be some offsetting effect, and so they said there must be some cost associated with bankruptcy. So that was kind of the beginning of this idea. There was a trade-off between bankruptcy and debt tax shields. Pecking order theory came about later, and it was really driven by Stu Myers in the late 80s. And it was in response to the fact that if you looked at the capital structure data as of the late 80s, what you found was kind of an interesting empirical regularity. What that was that after firms did an IPO, there was almost no secondary there was no additional issuance of stock by the firm or repurchase of stock by the firm. Those were very rare events. And what you basically saw was that 95% or more of the external finance of firms up until that point in time was basically debt. So to the extent that firms raised external capital, they raised it as debt. And there was very little additional issuance or repurchase of equity. And so he proposed basically a asymmetric information story. It's not, most agency stories are rooted in asymmetric information stories. It's not really an agency story. You might sort of twist it into an agency story, but it's really a very simple idea, and that is that the management and shareholders, you could think of as a single entity. They were faced with a project which had a very attractive payoff, which was not appreciated by other people outside of the firm. That if you try to raise equity to do that project, your payoff was diluted because the new shareholders weren't going to pay you for the value of that project because they didn't perceive it. And so to the extent that that sort of information asymmetry existed, what it meant was that firm was incented to use either retained earnings as the source of funds for the new investment, or to raise debt. And so his was in since it's kind of a one-armed theory, but the idea was this information asymmetry was another violation of the Modigliani-Miller conditions, and it gave rise to a circumstance where a firm would prefer to raise first money here, then if you didn't have retained earnings, then you raised it via debt, and then only in the extremist would you actually turn to raising equity. Then subsequent to that, there have been a number of theories that have really focused on timing, because one of the things that you notice if you actually look at behavior in the market is that issuance, whether it's debt or equity, tends to take place in certain windows of time in the market. So there's certain windows of time where if people are trying to raise external finance, they're more likely to. In other periods of time where they're very much less likely to. So you can tell various timing stories. And of course, the simple-minded timing story is just it's a valuation story. The insiders issue equity when it's overvalued, and so what is occurring during these timing windows are sort of insiders exploiting the market. There's problems with all of these stories. First of all, none of them are to cast them as real theories requires a lot more framework than in general was employed here. And once you try to cast them into kind of interesting frameworks, everything gets more complicated. But the sort of the long and short of it is static trade-off theories have been discredited for sort of two reasons. One is people found that direct costs of bankruptcy were in fact quite low and didn't really serve to offset Second thing is when you start really getting focused on what's the value of the debt tax shields, it becomes a tax incidence problem. And it turns out to be a lot more complicated than it looks. But probably the sort of simplest retort to the static trade-off theory was that there was no corporate income tax before 1909. Firms still use debt. So it can't be basically the whole story. On the pecking order thing, it was a great theory to explain why firms didn't actually engage in much secondary activity in their equity, except post 1989, about when the paper came out, firms started doing a lot of it. And so, which is not really explained by the theory. So now we see a lot more activity of firms both issuing and repurchasing equity in the market. And the market timing stories obviously don't really make sense from any sort of valuations-based stories don't really make sense from any sort of rational perspective. Like, if you know the insiders have more information and they're only going to show up when they think their stock is undervalued to issue, overvalued to issue more stock, then you should be smart on the other side and figure that out and not be willing to buy the stock. It's sort of like the classic lemons thing. So the simple-minded versions of the stories don't really hold up. So one of the questions is, why are these still around? Okay, as kind of the way that people think about this. First of all, there is a large body of empirical evidence now that supports asymmetric information effects. And so what we generally see is that if a firm issues equity, causes its equity price to go down. If a firm repurchases equity, it causes its equity price to go up. In other words, the market responds to the idea that insiders have more information and they adjust the price to take account of that. We also have, as I said, a lot of evidence that sort of, again, it's controversial, but the role of debt tax shields is just not that straightforward to actually work out and support. We can reject the direct cost of bankruptcy, and the simple insider valuation explanations don't work. So again, why are they still around? Well, first of all, since firms apparently manage their capital structures within reasonable bounds, and we have a lot of evidence of that, there must be a trade-off in there somewhere. So the idea behind the static trade-off theory broadly has to be right. There must be a benefit of using more debt, and there must be some cost of using too much debt. So there's got to be a trade-off in there somewhere. Asymmetric information matters. We have a lot of evidence that that's right. So in some sense, the kind of story that Stu Myers was trying to tell has to be right. Now, there's lots of different variations of asymmetric information stories. And as I mentioned before, timing shows up empirically. So there's something going on from a timing perspective. So that's why these stories are still out there. In other words, there's evidence that there's something like this that has to be going on.
Can I ask a question?
Sure.
Is it true or false that a lot of big tech companies don't issue very much debt or any debt at all? And if so, how does that fit into this discussion?
Generally, everybody issues some debt. So it's unusual to have someone that actually has really zero debt on the balance sheet. It's more common to see it in very small firms. So, like if you look at, recent IPOs and so forth, those firms tend to not necessarily have any official debt on their balance sheet. My own perspective is that debt is a little narrow, too narrow of a view to look at. In other words, non-debt liabilities ought to play into the game as well. And once you look even at very small firms, what you discover is that they often have significant amount of non-debt liabilities on their balance sheet. So So but the actual case of like zero debt on the balance sheet is actually relatively rare. It happens at times, but it's unusual. Okay, so that's just a very kind of quick survey of the theory. We're actually not going to spend much time on that. Okay. Where the field has kind of evolved to is because we know there's some content in these various ideas. There's some type of trade-off. And like in the static trade-off side, where it's evolved to is when people look at costs of bankruptcy now, instead what they talk about is indirect costs of bankruptcy. Since the direct costs of bankruptcy turned out to be low, indirect costs of bankruptcy are basically represent, again, usually information asymmetry. So you have a firm that gets into trouble and it's not able to easily transfer its assets. It can't just hand off the keys and there's sort of no loss of value in the transfer. So a good example, if you imagine a company that just basically owned self-storage units, right? It goes bankrupt, big deal, right? Everybody can kind of look at the assets. They know like these are self-storage units. There's like, it's a commodity type asset. It has a value. Those assets are easy to transfer in bankruptcy. What if it's a company though that has sort of very differentiated products and it's gotten into trouble probably because those products haven't been selling the way that they should? What are the assets of that firm? And what are they worth? And how could they be redeployed in other ways? Very difficult to know. And those types of information asymmetries are what people look at to find sort of indirect costs of bankruptcy. So basically kind of what you have going on in the last 20 years or so is a sort of mashup of these theories. And where people kind of tried to put them together in different ways to tell stories that would explain capital structure. Now, one of the interesting characteristics of a lot of these papers, if you look at it, is that there's a common set of variables that ends up showing up in all these papers, and that's because beginning about 1995, various researchers began showing that there were empirical regularities in the data that were quite consistent. We saw them over time, we saw them across different countries, and there's a number of them, but a particular set of them we've characterized as sort of the contemporaneous correlation model. And the contemporaneous correlation model has identified, somewhere between 4 and 7 variables that seem to be consistently correlated on a contemporary basis to the leverage of the firm. And so if you look at most of the papers that have been published in the last 20 years or so, people cast their models in a way that they can bring these variables into the paper and use them to support what their particular mashup of the model. And so there's lots of different variants and actually in some cases surprisingly different models that manage to kind of get the same variables into the analysis. And so part of it is because the variables themselves are generally accounting-based variables, and they're subject to different interpretations. So, if you interpret them to mean one thing, then they fit a model one way. You interpret them to mean something else, they fit a model another way. And so they don't necessarily shed us a lot of light on necessarily what the underlying theory is, but they are kind of the most kind of consistent empirical regularity that's out there. What are they? Well, here's a set of them. Profitability. Profitability is usually measured as operating income over total assets. And all of these are subject to multiple ways of measuring, but that's a standard way. Market to book. Again, there are multiple ways of measuring this. This is basically the equity market capitalization to the book equity of the firm. R&D expense, how much the firm expends on research and development. Tangibility, that's usually measured as the property, plant, and equipment as a fraction of the total book assets. Selling expense, that's basically selling, general, and administrative expense as part of the operating expenses of the firm. Risk, and again, there are multiple ways of measuring risk, but it's basically designed to represent the risk of the firm's cash flows, and size. And so, and these are consistently related on a contemporaneous basis. And what's a bit, in my view, bizarre is that they should be, because the arguments for most of them being there is that these are kind of represent latent characteristics of the firm. So market to book, for instance, is taken to be a measure of growth. So the idea is that, if you're a growth firm, you've got good growth prospects, then that can be measured by something like market to book. What's surprising is that, like, every quarter, if your market to book ratio changes, that your leverage would change in accord with that. In other words, it's surprising that on such a short interval of time, we would see like a contemporaneous correlation. So I'm not going to actually, we'll discuss these variables a bit more, but the basic idea is that if you actually kind of try to get behind what these variables might mean, as I said, market to book is associated with growth. Profitability, I think most people associate it with the uniqueness of the firm's products. So if you have some amount of market power because you're producing a product that cannot be readily produced by other firms, that tends to make you more profitable. And so profitability is a measure kind of the uniqueness of your product. So it means you're not basically in a commodity business. R&D and selling expense. R&D is related, obviously, to research and development. The idea is if you're a growthier firm, you're more likely to have more R&D expense. Selling expense is associated with marketing, and marketing is tied into the same profitability line. In other words, if selling expense is that you're spending more money on advertising, you don't advertise a commodity product. You advertise a unique product, show it has characteristics that differentiate it from those of other firms. And size is usually taken to be a measure of risk. There's some other, but again, most of these are subject to sort of multiple interpretations, since the underlying thing you're looking at is ratios of accounting variables in many cases. There's a number of possible interpretations that can be placed on this. So what are we going to do? We're not going to propose a new mashup. Okay, I have some of my favorite mashups, but that's not what this particular paper is about. What we want to do is to ask, do these correlations, can we really think about these variables as being causative in some sense? And what we're really trying to explore here is this a causal modeling approach. And why would you want to do this? Well, the idea behind the causal modeling approach, I think, is an interesting one. It basically says if you're willing to write down a model about how you think causation works here, what causes what, then that has empirical implications that you can test. And so what you can actually conclude, reach some sort of conclusion about is that you can say, my data is consistent with causation happening in this way. And so what we're sort of trying to ask here is, are these variables that are so widely used here, are these variables that we can think of as actually causing the firm's capital structure? And two, if that's the case, what's actually the causal effect of these variables? So, and what does that mean? Normally when you run a regression, at least the way I was trained as an econometrician, is the worst thing was omitted variable bias. So what you did when you ran regression was you kind of threw in everything, and then you kind of weeded out the stuff that didn't actually seem to matter. And that way you avoided omitted variable bias. The problem with that approach is if you have related variables, that all you identify via that approach is kind of partial effects. Like, what's the partial effect of this variable on this variable? And those partial effects are very influenced by how well you measure those variables. So if you have measurement error going on at all, it screws up what those look like. But in other words, if I have one variable which causes this variable and it also causes this variable, and I throw this one and this one into my regression as independent variables to explain this one, they're both going to show up in both cases. And they don't really tell me what's the experimental effect of this variable, which is the causal driver in the scenario I just outlined. So what you're trying to do in the causal model is something like an experiment. What you're trying to do is like a laboratory experiment. You're sort of trying to ask, if I change the value of this variable, what effect do I expect to see on the other variable? The regression coefficient doesn't answer. The idea of the causal model is it tells us exactly what we need to control for in order to estimate the causal effect of this variable on the other. So we get a different estimate than we get out of the say OLS approach if we do the causal modeling approach. Then the last thing I would say here is that we found it, I think, I've certainly found it quite interesting to kind of explore this line of approach. The structural causal modeling approach, though, is a pretty stringent framework. And when you sit down and look at a real world problem and try to wrestle it into that framework, you discover it's not that easy. And in fact, you end up having to kind of like wave your hands over some things. So I mean, a very simple way to think about it is like, suppose you're trying to explain a price. You have variables that explain supply and variables that explain demand, right? But the price is both an effect of the demand and a cause, right? In other words, our demand function depends on the price, right? So the causation goes both ways. And so in structural causal modeling, basically is looking to find A causes B. If A causes B and B causes A, that's hard to deal with in that framework. So I think kind of one of the interesting things here is when you actually try to take the capital structure problem in a very simplistic version of it and squeeze it into the framework and see what do you actually get. And does it make sense? And do you believe the framework to a certain extent? So one of the things we want to sort of point out as we go along here is kind of what some of the weaknesses are in our view of kind of trying to squeeze the problem into that framework. So on that note, I'm going to turn it over to Simone because I've already spoken much longer than I intended to. And how am I going to do that? I'm going to get some help here.
I think Simone.
Shall I share my screen now?
You
Yeah.
have to stop sharing first.
See.
Okay. Can you see my screen?
Yeah, we can see it.
Okay, great. This worked. Do you still see it?
Yes.
Good. Can I go?
Just 1 second.
Oh yeah. Yeah.
The projector. Okay. Yeah. But it's now we only see a black screen on your end.
Oh, okay. Hang on 1 second. Maybe it's the full screen that doesn't work. What about now?
Yeah, now it's good.
Now it's good.
Okay. Well, it's gonna be not full screen, but it should be fine. Okay. Thanks for the introduction, Steven. And again, thanks for inviting us here. Yeah. So I just take from where Steven left us. What was the goal of this paper? The goal of this paper was basically to say, okay, there is this number of empirical capital structure regularities. We wanted to revisit them from a causal standpoint. Now, the way we look at like doing causal inference from empirical data is kind of a two-step process, right? You first have to solve the problem of identifying which causal structure has generated your data. So you have an ex-ante identification of causal structure problem. Basically, what causes what. After you have that estimated, you can go and estimate your causal effect with a variety of methods. And in fact, most of the literature that is out there focus on this second step, so the estimation of causal effect. What you're focusing here instead, on the other hand, is the problem of identifying causal structures. So identifying how the different determinants of leverage are related between each other and with leverage from a causal standpoint. And we want to do this using structural causal modeling for a number of reasons that will be clear in the next few slides. But before I start talking about structural causal modeling, just want to make clear what are the two questions that you're asking. So the first question is, how are leverage and its determinant causally related? And this is going to be the vast majority of this presentation. So how can we develop a structural causal model for leverage? Only then we can go out and try to estimate the causal effect given that causal structure and to compare them with the empirical association that typically just derive from statistical models. Okay, so the next few slides will really be an overview of structural causal modeling. So I want to take this as a discussion. If you have any question at the time, please stop me. We're gonna go back of the problem of capital structure in like 10 slides or so. So I said in the previous slide that most of the literature focused on the second step of causal inference, which is estimating causal effect, where here we focus on identification. Why is identification so important? To answer this question, like we came up with this just numerical example, which I actually think is quite interesting. Let's say that you have been given some data. Okay, you have some panel data of 4 variables, y, x, s, and r. You know what these variables are, and you have been asked to estimate the effect of x on y. So just as Steven was saying before, the typical way of doing that is to run a series of regression, having different variables inside it, different control variables, and then look at how much these different models explain your dependent variable. For example, here I have two models, one in which I'm just regressing over x, and one in which I'm regressing over x and controlling for r. And if we look at the two models from a classic statistic point of view, it is clear that the second model, model B, is the best one, right? It explains much more of the variance of your variable. If you look at some, I think your residual, the normal residuals, all the conditions for linear regression are satisfied. If you look at other quality of fit variable, like the B, the A, they're all better for model B. And therefore, we will conclude that X has an effect on Y, as a positive and statistically significant effect on Y. The problem is that I have generated this data, so I know that, in fact, model A is the right model, right? No one would have selected model A over model B, but in fact, model A was the right model to select, and there was no effect of X on Y. So what I want to say with this, basically, this should be very worrying, right? You have a very simple data set, just 4 variables. You try 2 models, you have 2 different coefficients from the 2 models, but effectively you have no statistical measure that help you select the correct one. The fact that one model explains better your data than the other one is not enough to guarantee that the coefficient from that model is the actual correct parameter that you're going to estimate. And this is not just an exercise, right? Problem of the kind happen all the time. And this is exactly what motivated this paper in the first place. This empirical problem that we find capital structure works. So Steven showed a table of classic relationship between different determinants and leverage. One of them was size. Now the trade-off theory, Steven was saying, predicts a positive relationship between leverage and size, whereas the pecking order theory predicts a negative relationship between the two. All this model of capital structure that you found there, all the empirical tests, their goal is to look at this coefficient and then decide which theory is more consistent with the data by looking at the sign and the magnitude of this coefficient. And generally, the vast majority of the work out there shows that there is a positive relationship between size and leverage. However, 2 quite old papers now, one by Folklander and actually other 2 by Ovakimian et al., show that if you control for whether or not a firm chooses to issue rated debt, then the sign of this relationship changes and switches to negative. So this is exactly the same problem that we had before, right? We have 2 models, we have 2 coefficients, but we have no way to tell which one is the right one, because all the discussion around these 2 models and all the motivation for these models are of a statistical nature, they're not of a causal nature. And no statistical measure can help us select the correct one. So in a way, what we want to do here is kind of resolve this problem as kind of corollary. But let's go back to the theory. Let's go back to the numerical example. How can we select the correct one ex ante? So how can we identify the causal structure of the data generating process ex ante? The way we do it is basically we translate the structural model into a graph. Okay, this is called a causal graph, and it's the graphical representation of the structural model. Each arrow, each node in this graph is a variable, and each arrow represents a causal relationship between the two. For example, here you have X, that is just a normally distributed random variable, and so it's just a noise and doesn't have any arrow going into it. R depend on both X and S, so there are 2 arrows going to R. S has no arrow going to it, and Y has an arrow going to it from S, just as you will read out from this model. Now, before we saw that if we don't control for anything, we can find the true unbiased effect of X on Y. And looking at this graph, and we'll make this clear in a few slides, but you can already start to see why that would be the case, right? The path from X, there is no direct path from X to Y. The path is blocked by this variable R. And what happens when you control for R is basically you get some information about S, which in turn gives you some information about Y. So controlling for R is what is typically called a collider bias. You have a bias because you are kind of getting information for free about Y through the relationship that S has on R. And this is actually one of the reviewers of the paper pointed this out. This is kind of the opposite of an omitted variable problem. It's a not omitted variable problem. And if you basically put all the variables you want in your model, which is a standard approach, you might risk ending up putting a variable that induces a bias, just as omitting a variable could be a problem because it will induce a bias. So you're kind of screwed either way. And what you have to do is to really understand what is the causal structure of your data generating process. So basically estimating an unbiased causal effect, it's all about finding the right condition set. If you don't do that, which is step one of our causal inference problem, it doesn't matter how good your estimation model is in your step two, you're not gonna get an unbiased effect. But the question is, how do we do it, right? This was a very easy, well-controlled example, and already seems quite complicated because in reality, we don't know the model that now we just wrote down. In reality, and particularly in corporate finance, we have a lot of variables there. We can build any ratio we want. How can we derive this graph when we have no information? And here is why we have decided to take a structural causal model approach, because as Steven was saying, it forces you to write down your model. In other words, you need a story. I think one of the most important lessons of structural causal modeling is that causal inference cannot be, should not be, an entirely data-driven problem. You need a story behind the model that you're writing. So how do we come up with a story? Okay, the problem is always the same. We don't know the model. We only see the data. So let's say, for example, here, we only see these three variables, Y, X, and Z. To come up with a story, basically, we need to formulate hypotheses. And we can say, okay, let's say that I want to measure the effect of X on Y. One hypothesis could be that X and Y are completely independent, but they both drive Z. This will be the collider graph that we saw before. Or we can have the opposite, right? X is, again, completely independent on Y, or Y is completely independent on X, but they're both driven by the same factor Z. And this is what is typically called a fork. Or alternatively, we could have a chain. So basically, Z drive X, which in turn drive Y. And it's very important to know ex ante which one of these three possibilities is most compatible with the data, because otherwise, when we're going to estimate the effect, we risk either omitting or not omitting a variable. For example, if we wanted to estimate the effect of X on Y, and the true graph, the true model was this collider on the left, then controlling for this will induce a bias. If instead the right model was the one in the middle, the first, then we have to control for this to remove the bias between X and Y. If on the other hand, the right model is the chain, then whether we control for this or not is irrelevant. Now, each of these models or each of these causal graphs entail a set of conditionally independencies. The collider basically tells you that X and Y are unconditionally independent. As you can see here, there is no arrow between the two, but they become dependent once we control for Z. And this is why controlling for Z induces a bias. In the fork, we have the opposite situation. X and Y are unconditionally dependent because they both depend on the same factor Z. And when we control for it, so when you condition on Z, X and Y become independent. In the last example, the chain, the control is irrelevant. X and Y are conditionally and unconditionally independent. So once we have the right graph, we know exactly what to control for to estimate unbiased causal effect. And the hard bit here is to actually derive this graph, because these are, again, a very simple example, but as Stephen was saying before, when you go to real world data, real world problem, the situation is very complicated. You have a lot of variables and a lot of possible dependencies between these variables. But the trick is, you can take an arbitrarily complex causal graph, and you can decompose it into these three simple units. So, for example, in this graph, Y, Z, and X form a collider, Y, Z, and U form a chain, and T, S, and Y form a fork. The first step of a structural causal model approach is to test whether the study we have in mind agrees with the data by testing those conditionally independencies that are entailed by each of the hypotheses that we have. How do we do it? We use the concept of de-separation. Okay, sorry, I know there is a lot of text here. This is a bit convoluted definition. I'm going to have an example in the next slide that hopefully is going to make this a bit more clear. And tell me if not. But basically, the definition of the separation is that a path between two nodes in a graph, say X and Y, is blocked by a set of nodes, say Z, if and only if in this path between X and Y, there is a chain or a fork such that the middle node is in Z. Or alternative, the path contains a collider such that the collision node is not in Z and no descendant of the collision node is in Z. Which is very confusing. It will be clear with an example later. But if Z blocks every path between two nodes, X and Y, then X and Y are de-separated, conditional on Z, and therefore they are conditionally independent given Z. So once de-separate... Sorry,
I have a question. Can we go back to 2 slides? I was just wondering about the one before that. Is that Z where Z should be at the beginning? Z control. Z should be at the beginning like that and not in the middle.
sorry, say again.
I'm looking at the third graph, the third one.
Okay, yeah.
Is Z in the right place?
Yeah, I mean, yeah,
I
yes.
was expecting it to be in the middle.
If it was in the middle, then this would not be true, right? If it was in the middle, if it was X that drives Z, that drives Y, then when you control for X and Y will be conditionally independent. So yeah, you can have a graph just as you were saying, in which Z is in the middle and X is at the beginning. It would have a different conditional independence.
Yeah.
So yeah, it's I mean, it's an example. If you have a different example, you will have a different conditional independence there.
Okay.
Do you see? But you see why, right? In this case, controlling for Z doesn't block any path from X to Y, right? So
right.
after you condition on this, they're still dependent.
Now that
If
one's obvious, but I'm kind of interested in like collider, confounder, and then mediator. So I think of.
yeah. I mean, yes.
Z is not playing the role of mediator.
No. In fact, it's not. That's right. It's not. I mean, it's not. Z is not a mediator here. The mediator should be in the middle and X should be on the left. Yeah.
Okay, sorry.
That's correct. Okay. Just to go back on the separation problem, the concept of separation, I think the only thing that you should remember from this slide is that the concept of separation allow us to determine the implied conditional independence of a causal graph. So just as an example, we don't have to spend much time into it because it's not going to be super relevant for the rest of the presentation, but just to understand a bit what separation is. Now, following the definition before, R and Y are separated using an empty set. Basically, because there is a node, W, which is a collider in the path between R and Y, I don't have to condition on anything to separate R and Y. So they are unconditionally independent. And they become disconnected if we condition on W. Because in the path, there is a collider and we condition on the central node of the collider. So L and Y are conditionally dependent given W. Now, this is just a simple example, but the general idea of these two slides is to say there is this concept of this separation, which can be used to infer what are the conditional independencies implied by an arbitrary complex causal model. Now, let's go back a bit into a discussion on how these relate to standard regression approaches, right? There is structural causal model and statistical approaches, like regression approaches, they start from the same premises. In both cases, we formulate a hypothesis. Okay, because we do formulate a hypothesis also when you run a regression model. We think that certain variable should be in your model because otherwise excluding them will bias your estimated coefficient. The real difference between the two approaches, so a causal model approach and a statistical approach, is that in a regression, you don't really have an ex ante test that you can do to validate your hypothesis. Whereas in a structural causal model, you have the possibility to test your hypothesis ex ante and reject them. If your causal model is actually not validated by your data, meaning that when you're going and measure the conditional independence implied by the model that you had in mind, they don't agree with your data, then your model is probably wrong. And you have to go back into it and adjust it. It's a pretty long process. It's a loop. You have to go through your model, test all your independencies, and make adjustments until you get to a model that makes sense from a theory standpoint, and is also consistent with the data that you have. After this step, which we don't have in regression you just estimate your regression coefficient, and you give interpretation to them. Whereas in a structural causal model, you perform this step, and then you use the concept of separation and what the so-called backdoor criterion, which I'm not going to present here because it's irrelevant for what we have to do, but it's another very important concept in structural causal modeling. You can use these two definitions to identify which one are the variables that you have to control for in order to estimate the type of effect that you want to estimate, whether that is a total effect or is a partial effect after controlling for some mediator factor, for example. And finally, you can estimate your unbiased effect with any way you want. You can use regression, you can use your propensity score, or you can use what is called the do operation, which is actually another important contribution of structural causal model to causal inference, which we're not discussing here, but it's basically a procedure to estimate causal effect by simulating what you would do in an experiment. You basically compute the probability that your dependent variable take on a certain value, given that you had done a certain intervention on your causal factor. So in fact, most of structural causal modeling is based on the calculus, and it's an important part of it, but we are simply not doing it in this paper, so I'm not going to talk too much about it. But something else I want to say is sometimes it's a bit too much. Even if we do all of this, sometimes it's going to be a bit too much to claim that what we estimate are actual causal effects. At the end of the day, we're working with empirical data, and it is a very strong claim to actually accept that even if we follow all the rules, we end up with a proper causal effect. But at least, even if you're looking at a statistical association, structural causal models still help us reducing all the bias that we will have if we don't control for the causal structure. Okay, now we are getting towards the end of this overview of structural causal modeling, and Ian will take over again to talk about the model for leverage. But before we go there, I talk a lot about conditional independencies, but how do we actually do it with the data? Right, so I want to talk just a little bit about it because this is going to be important to understand our results later. Now, if we have a simple model, a linear model with normally distributed noise, it's very straightforward to calculate conditional independence. You basically regress one of your variables on the conditioning set, in this case, just z. You then regress the other variable independently on your conditioning set, again, in this case, just z. And then you look at the residual of these two bits, and you look at the correlation coefficient between these two residuals. And we can do it with an example. You can generate synthetic data from a linear model with normal noise, and we can run a linear condition dependence test on the synthetic data that we generate. And we find that, for example, in a fork, x and y are conditionally dependent, so the p-value of your statistical test is 0, and they become independent when you condition on z. So your p-value is going to be greater than the threshold you want, 0.1. Similarly, if you have a chain, similar condition independence, and here it is, here z played the mediator factor, as you were saying before. And the collider is the opposite. Unconditionally, x and y are independent and become dependent after we condition on this. But sometimes it's a bit too much to ask that your noise is normally distributed. And in case of non-Gaussian distribution for your noise, or generally for non-linear model as well, zero partial correlation is not necessary, it's neither a necessary nor sufficient condition for independence. And we can repeat the same experiment. We basically generate other synthetic data using non-normal noise, using like a beta distribution in this case. And you find that if you run a linear conditional independence test, your results don't make sense anymore. So what we're going to do in this work, we're going to use a non-parametric conditional independence test that is quite widely used, and we're not going to go into the details of this. The reference is the one below, it's Straub et al. In the Journal of Causal Inference, and there are codes available to run it in R and might be in Python as well. But it's based on the idea that, on the observation more than the idea that x and y are conditionally independent given z, if and only if the partial cross-covariance matrix is equal to 0. And this if and only if the norm, the Hilbert-Schmidt norm in the Euclidean space is equal to 0. So the statistical test is basically a test on the norm of the partial cross-covariance matrix. And we can see that the algorithm works quite well, because if we now use the same model that does a non-Gaussian distribution for the noise, and we again run the non-parametric conditional dependence test, we find the results that we would expect to see, which are the one that I discussed before. Now, what we actually do in this paper is a bit different. And the point is, data in empirical finance tend to be very noisy. So I would have a hard time just taking a p-value and trusting it blindly. So we're trying to increase a bit more the power of this test by slicing our panel data into year and a subset of the year, and then run condition independence test for each of these subsamples. And then rather than looking at the p-value or the condition independence test itself, we look at the distribution of the p-value of all these condition independencies. Because we know that if these p-value are distributed uniformly, then all those p-values that were before 0.05, that were as likely as those that were more than 0.05, and that's where effectively the effect wasn't there, and the condition dependence wasn't actually justified. So to be more specific, let's take this example. Let's say that we want to compute the condition independencies of this fork on the left. Okay, we first compute an unconditional independence test for many subsamples of our population, say, and we get this blue distribution. Now, all this just tells us that all the p-value of those tests were very close to 0. Then we run this series of conditional independence tests by conditioning on J, and we find a uniform distribution. We then use a chi-square statistics to look at how much a distribution is close to a uniform distribution, and we look at the p-value of the chi-square. What this is telling us is that the p-value was 0 before the conditioning and was greater than 0.1 or 0.05 after the conditioning. So the hypothesis is correct in this case. And similar, this is another example on the right using a collider in which we find the opposite result. So what we want to expect, just so that I'm going to show you a table later, what you will want to see in the table is that a condition independence is satisfied by looking at the chi-square of this test. Now, just a few observations before we go back into the capital structure problem. Two-track causal models, basically what they do, it tells you which variable you need to control for to estimate causal effect. It helps you identify the correct causal structure of your data generating process. I think, to me, that is the most important contribution of two-track causal model. And it's particularly important in econometrics, and I would say in empirical capital structure as well, because there is always a disconnect between the formal model or the theoretical model that someone developed and then the empirical implementation to test the validity of that model. And what SCM does is forces you to write down an explicit version of your theory using your empirical variable and understand how they act on each other, and to test it, right? And to actually test your hypothesis before you go there, you estimate your coefficient and you give some interpretation to it. Now, Steven, do you want to talk about the causal model?
Sure, yeah, I'll just let you roll the slides for
Yeah.
So And so let's just start here. So the way that we think about, so what we're gonna try to do now is to create a sort of the minimum structure that we can to look at the effect of these contemporaneous correlation variables. So that's kind of the task we've imposed on ourselves. Can we kind of shoehorn these things into one of these structural causation models? And if so, what does that look like? Okay. So the basic idea when you're looking at a firm here is that the firm's got two key decisions it's making. One is an investing decision. It's like, hey, this is how much we want to invest. So there's some opportunity the firm is faced by. And then after it makes that investing decision, then it makes another decision on how to finance that. Okay. Now, we don't directly observe those decisions, right? We only observe like the outcome of those actions. And in particular, the outcome that we're interested in here is the capital structure outcome. So the financing decision is going to lead us to a capital structure outcome. So that's what this graph shows here is how we're thinking about the capital structure decision here. Now, this is a kind of merge and ask framework for what's going on. So the investing decision basically has two impacts. One is it determines the volatility of the overall business. So if the firm takes on a riskier project and makes a decision, we want to invest in a riskier project, then the volatility of the firm is higher. If it decides it wants to invest in a safe project, the volatility of the firm is lower. So the volatility is caused by the investment decision. Second thing is that it causes the value, right? So that you are pursuing a particular opportunity, and that creates the value of the overall business. Then the finance and the investing decision then, of course, has a cash flow requirement to invest. And so actually just stay on the previous slide for a minute, if you don't mind, just before we complicate things. And so the financing decision leads to a choice of in essence, firms produce cash flow. Now, sometimes they actually don't produce any cash flow, but generally they produce some cash flow internally. The decision they always face is how much of that cash flow do we pay out to our shareholders, and how much of that do we reinvest for our shareholders? And also, do we raise additional external financing? Okay. So the kind of key decision for us is that additional external financing, which is the liability decision here. So the financing choice leads to a decision. And notice the firm can decide to raise liabilities and pay out the money to shareholders, right? To do both. Now, the equity value we view as the equity as a derivative. Once we know the asset value, once we know the liabilities, that's going to determine what the equity value is. And so the equity value is not directly acted on here; it's an outcome of the action. The leverage we're going to measure basically as the liabilities relative to the asset value of the firm, right? And it's ultimately the leverage that we're trying to explain in this model. Okay?
Just want to ask questions for people maybe not familiar with Burton. The asset value is like the value of the enterprise, like the debt plus the equity, right?
Yeah, it's basically if you own all the claims on the firm. So if you own the equity and you own all the liabilities of the firm, including the debt claims, right, then you would 100% own the assets of the firm, right? So you can think about sort of adding up the whole the market value of the right-hand side of the balance sheet, and that tells you what the assets of the firm are worth. And so that's what we're calling asset value.
Right, and then we have this funny thing, asset volatility, which is even harder to observe than equity volatility. So we have to back that thing out with the market model as well.
Yeah.
From
right.
estimates.
But the idea is that the market value of the assets, they have a volatility. We observe the equity vol, which is derivative of, so we can work out relationships between those things. But again, it's not that important for our purposes here. We're just trying to kind of show the structure by how you get to leverage from these decisions. So where the modeling really comes in is sort of now, before we move on to the next slide, I'll just point out one other thing here. The investing decision and the financing decision, notice we've created a chain here, right? So this is a chain. investing, and then financing. What the structure doesn't allow is it doesn't allow that there's basically an external constraint on the financing so that you wouldn't undertake the investment. Right? In other words, if you believe that, sometimes firms want to invest, but in fact, they can't raise the money externally. So what we're assuming here is that they're basically always able to invest. Because if we have causation going both ways, that's not going to work here for us in general in this structure. So we need this kind of change. So again, this is an example of kind of where you're kind of shoehorning things in here a little bit. So if you were trying to look at the question on, are firms financially constrained, does that affect their actual investment choices?
And is the graying out in the dotted line indicating that we don't observe these things? Or
Yeah, I mean, these investing decisions, financing decisions, we don't observe.
so we distinguish them from things we can either
That we can actually
observe, but then asset follows quite in that category, but we pretend like we can observe it.
Yeah, I observe.
Yeah, I know, yeah, but you're unusual in that regard.
Okay, so now let's go to the next slide. Okay, so now what we've tried to do is bring in all our variables, right? And try to figure out how do they fit in this picture. In other words, what is acting on what? Okay, so this is obviously complicated, but let's just try to take a few simplified views. So one of the things that we're going to control for here is the macro environment. We have a couple of macro variables that we're going to use. And what we're assuming is that those act on the sales, right? So a macro environment affects how much we're actually able to sell. They act on the value of the firm. So the macro environment, affects how firms' assets are being valued. And it also influences what investments which we make. Okay. So that's a relatively straightforward case. Okay. Market to book. Where does market to book come in? We have to be very careful with market to book. And again, here we're finessing things a little bit, right? We need to know the market to book at the start of the period. So you can imagine here that there's a start of the period, end of the period, right? Because some of these variables we're looking at are flow variables. Some of them are stock variables. Okay, so like the asset value is a stock variable. The book value is a stock variable. And so that's going to start at our beginning of our interval, and it's going to end up at a different value at the end of the interval. So we've got the asset value over here on this side as well. So that's asset value T1. This is asset value T0, okay? And so what we're assuming here is that when we look at market to book, we're looking at this ratio of the asset value of the firm to the book value of the firm. And that's a known variable as of T0, and then that's going to influence our financing decision, say. So what we've assumed here is take a measure of something like tangibility. Tangibility is basically saying of the various productive assets that I have, some of them are very tangible. So they are property, plant, and equipment, say in our specific definition terms. And the thing about property, plant, and equipment is that those are easier to finance. Why are they easier to finance? Because they're easier to transfer. So it's like if I get into trouble, those assets in general can be transferred more easily than say some intangible assets. The intangible assets of the firm might be tied up with people and so forth who might go and work for somebody else if the firm gets into trouble. So for us, tangibility it is not influencing the investing decision, but it's influencing the financing decision. So we can finance that in a different fashion, okay, because of the tangibility. Profitability, kind of a similar story here. Now, notice we've got a arrow going from book assets to profitability. Why do we have an arrow going from book assets to profitability? Because we're measuring profitability as operating income relative to book assets. Right? And so book assets are part of the profitability measure, and so therefore they are costs in this case. So that's like a kind of definition of cost. But nonetheless, it's a cost that we need to worry about in the specification of the model.
You know, I'm getting a little worried about the time.
I am
Just to let
too,
you know.
Yeah.
But this is obviously, I could go on and on about this all day. I love the subject, but I hope we get to see the
Results. Okay.
This is just an amazing diagram. Not the most complex one I've seen, but obviously a lot of thought went into how to draw those arrows and.
Yeah.
And
Okay.
stuff.
No, I think you're right. So
Sorry, Steve,
Ronnie,
can I-
let's roll. So over to you.
Okay. Okay. Let me explain then. I think you're right. It's almost 12:30 there. So let me explain basically how we validated this model. So basically, we kind of have taken a counterfactual approach. Like there are a lot of lines here, and what we want to see is whether those lines exist or not. Take the example of profitability. Okay, what we want to test is whether there is a path from profitability to leverage. The path that is here depicted as a dotted red line. And this U here just represents idiosyncratic drivers. Now, if this path didn't exist, okay, then this model will imply two conditional independencies. Leverage would be conditional independent to profitability after conditioning on book asset and operating income. Now, this is a very trivial conditional independence test because profitability is defined as the ratio between your EBITDA, your operating income, and your book asset. So this is not really a good conditional independence test to perform, also because the algorithm doesn't really work with deterministic variables such as this ratio. At the same time, this separation tells us that leverage is conditionally independent on profitability, conditioning on operating income, market to book, sales, and tangibility. And you can kind of see that without thinking too much about the definition of the separation, because you're basically what you're doing, you're conditioning, or in other way, blocking all those paths that goes from profitability to leverage on the back door, right? If you remove the arrows of this graph, you can see that there are a lot of paths from profitability to leverage, and you want to block all of them, all of those. And you can do that by controlling operating income because you block, for example, this path here, and or this path here, and you can do controlling conditioning on tangibility and market to book. Now we can run exactly those tests that I was talking about before, and the distribution will not look as pretty as they did in the numerical example. But basically what this is telling us is that unconditionally, so the blue distribution here, profitability and leverage are dependent. Okay, most of the value are below 0.10, and this distribution is not uniform. After we condition, we lose some of the dependence, but yet we still have a non-uniform distribution of this distribution of p-value. And therefore, we conclude that the data support this particular structure of the graph. So the structure that has a link from profitability to leverage. Now, we're going to do this for every variable in our graph. And I'm not gonna do that because it's just too boring. but you see where we're going, right? We basically take this counterfactual approach. We remove the link. We look at what would be the conditional independencies implied by the graph without the link. We test them. If they're not satisfied, then it means that the link existed and the graph was right. But one observation I want to make here is that obviously this doesn't prove conclusively that the link exists, because this still doesn't solve the omitted variable problem. There could be another variable in this graph, and after I condition on that variable, the conditional independence is satisfied. So I think that this is quite important to bear in mind. If we satisfy the conditional independence, we know that that is true. But if we don't, we cannot guarantee 100%. Now, this is the table with all these t-square statistics from conditional on the left, unconditional on the left, and conditional on the right. Don't need to read it all. Don't have time for that. There are 3 points I want to make here. Point number one, obviously most of these relationships are correct. We are not cheating here. They're correct because we spent quite a lot of time going back and forth with our theory and the data until we find a theory that makes sense with the data. The only two that we couldn't square are research and development and operating risk, which are the two red ones here. Now, operating risk is just a definition of risk that is used a lot in capital structure literature, and is the rolling standard deviation of profitability. It's honestly not a great definition of risk. And if you look at it, leverage and operating risk are not even related conditionally. This is a very noisy variable. There are seasonal effects that are a problem. Research and development, on the other hand, we think that we can't satisfy this hypothesis because this is, again, a variable with a lot of missing values. And in fact, in a lot of work, people use a control as basically a binary variable that tells whether a company was reporting on research and development expenses in the 10K that particular year. So I think that link should be there. We couldn't satisfy it, most likely because of a data problem, but cannot guarantee that.
Simone,
Anyway, I think
we're about to lose our room.
Yeah, I think we can finish here.
I apologize.
No, I apologize. It took us too long.
Thanks a lot.
Oh,
Thanks.
yes, I want to thank you. I'll send you a note. That was fascinating.
Yeah.
And there are many follow-ups. Just want to say to anyone who has not read Udea Pearl's book called The Book of Why, a lot of background, a lot of what we saw here today will come into beautiful focus from all of Pearl's narratives. And I love this work, so thank you so much.
No, thank you very much again for inviting us. It's been a pleasure. Thank you. Bye-bye.